The cryptocurrency world has reached so many important milestones that it can easily feel overwhelming. But here's the real game changer. On September 2nd, the U.S. Securities and Exchange Commission, SEC, and the Commodity Futures Trading Commission, CFTC, jointly announced a policy shift that might be the most significant moment yet for crypto in America. They officially allowed U.S. exchanges to list certain crypto asset products. This move could redefine the future landscape of digital assets. Market participants should have the freedom to choose where they trade spot crypto assets, said SEC Chairman Paul Atkins in the joint statement. He emphasized that the SEC is eager to collaborate with the CFTC to create a regulatory environment that both supports innovation and promotes healthy competition as these markets rapidly evolve. Why is this so groundbreaking? For the first time, two of the top U.S. financial regulators are speaking in unison about digital assets, marking a clear change from years of bureaucratic turf wars that actually pushed crypto innovation outside the U.S. border. Liat Shetrit, Vice President of Global Policy and Regulation at Elliptic, a blockchain analytics firm, described this moment as almost a healing moment. She sees it as a critical opportunity to restore confidence in the crypto industry and to foster innovation right here in America. This restored confidence might be crucial. Until recently, many crypto businesses were essentially testing the waters overseas, scouting out Europe, Asia, the Caribbean, anywhere they could seek clear and supportive regulations. Many were leaving the U.S. in search of better clarity and understanding. But that tide is turning. Shetrit shared that there's a genuine excitement building around bringing crypto innovation back into the U.S. market. Institutional interest is also resurging, influenced by the wider global effects of regulatory signals like this joint SEC-CFTC statement. Banks and asset managers, who had previously sidelined crypto strategies after shocking events like the FTX collapse, are now revisiting and rethinking those decisions. Although some remain cautious, the regulatory cooperation has reopened dialogues about exciting areas such as tokenization, stablecoins, and collaboration between traditional finance firms and crypto-native companies. For instance, Nasdaq recently filed a proposal with the SEC aimed at enabling the trading of tokenized securities on its exchanges, another sign that the crypto space is building stronger bridges with established markets. Shetrit points out that regulators are pooling their knowledge and resources. They share software, tools, and insights, which helps shape better markets internationally. This cooperation has deep ripple effects, influencing regulations and market practices beyond U.S. borders. Innovation in stablecoins, tokenization projects, and banking partnerships with crypto startups is also thriving under this environment. However, these conversations often circle back to one key theme: risk literacy, especially understanding the origins of funds. Historically, any wealth tied to digital assets raised red flags, often leading to compliance scrutiny or even financial exclusion. Today, there's a move toward a more nuanced view, one that recognizes not all crypto-related funds are inherently risky. These shades of gray help financial institutions differentiate between potential risks and legitimate activity. Shetrit stresses that with proper knowledge, tools, and understanding, the industry can manage these risks safely and effectively. But achieving this level of comfort and trust across institutions requires ongoing dialogue and education. Now, here's where things get controversial. Although the joint statement signals forward momentum, it's only a staff-level announcement, not an official rule or law passed by Congress. This reflects the broader tension in the U.S. crypto market today. Optimistic, but still cautious, hopeful but waiting for clearer formalized rules. After years of abrupt policy changes and regulatory uncertainty, there's a growing appreciation for steady, incremental progress rather than sudden reversals. One comfort for the market is that existing financial regulations, such as anti-money laundering protocols, sanctions enforcement, and fraud detection procedures, can often be adapted for crypto, rather than invent it from scratch. There's a whole set of existing compliance frameworks that can literally be copy-pasted over to crypto, Shetrit explains, and then refined to ensure they work well with digital assets. In other words, the main challenge isn't creating new rules, but educating and training compliance teams to apply familiar legal principles to this new asset class. Because crypto is inherently global, international regulatory harmony isn't just a nice-to-have, it's essential. The recent move by the U.S. might speed up efforts towards such coordination. But Shetrit underscores that the devil is in the details. From America's perspective, everything is a go signal right now, but we still have to figure out how to operationalize these policies, she notes. The real test will be how well all players, from regulators to compliance officers to product developers, can align their efforts. Those institutions that succeed in creating this smooth orchestration could enjoy significant first-mover advantages in the rapidly evolving crypto space. So what do you think? Is this regulatory cooperation the breakthrough crypto has been waiting for? Or just another temporary patch in a turbulent market? Are we truly witnessing the dawn of a new era for digital assets in the U.S.? Or will this optimism quickly face new challenges? Share your thoughts and let's discuss.